Welcome to Professional Car Washing and Detailing's Executive Spotlight. I'm your host, Rich DiPaolo, and joining me today is Jeff Pavone, founding partner of Amplify Car Wash Advisors and owner of Commercial Plus. Jeff, it's great to see you today.
Rich, likewise. Thanks for having me.
Absolutely, yeah. Welcome to our office at Babcock's Media in Akron, Ohio. Do you get to this part of the country a lot, or?
I can say closest I get is Chicago.
Chicago.
I probably get to Ohio maybe once a year or so.
All right, well, thanks for joining us. The weather's getting chillier around here, and you're getting in right before the snow comes, so that's a good thing, right? So I want to spend some time with you, Jeff, to talk about not only your background, but also the trends that are emerging in this car wash industry. You know, you and I have spent a lot of time in recent years talking about the evolving trends. Things kind of changed a little bit these last couple of years, so I wanted to catch up with you and get an update if I could.
Sure.
But first, why don't we start by understanding your background a little bit and how you got started in the car wash industry. How did you make your way into this industry and helping operators as you do?
So back in the late 90s, I was in the internet space, sold a company, moved out to Arizona, and I really just invested in a car wash, and then we had several. And at that time, I realized that the space I was making these investments in the between the broker and the guy that sold me car washes, I was at a disadvantage, right? and I end up looking at that, and I was looking for a career change. We had just sold our company, looking for a career change, and I looked and said, I just really felt at least I felt that we needed better representation. So at that point, I literally got licensed, and this is probably in early 2000, and dived right in. Without knowing a whole lot about the market itself, but and it was one of those business where it took us, it was years to sort of pick off one client at a time, just in Arizona, and that's really how we got started. But we brought, if you look at Phoenix has got some of the largest chains in the country. We were blessed to start working with them as a brokerage, and then evolved into becoming, we became really the source for doing their M&A work by building out our team. So sort of a long journey, but 20 plus years in it.
Yeah, there's worse places you could start in the car wash industry than Arizona. Definitely a lot of big chains out there, and as you got into this industry, Jeff, I understand that you've diversified your services over the years. So what does Amplify Car Wash Advisors, what does it do? Can you give us the 100-foot view of the services
Sure.
that you offer today?
Nothing's changed from when we really first got in it. When I made that, when I started meeting with Bill Martin, my partner at the time, now, Bill and I talked about the space was getting a lot of interest from private equity, and we really wanted to be helping operators and really being on the side of the operators, so they understood what they were getting into, and so we really wanted to represent the interest of the operators. That was always the problem. Now, we just happened to hit a time in the market where deal flow was happening at a record clip. And I would say our natural evolution was really we wanted to become full-service, long-term advisors to the car wash industry, and again, representing the interest of the operators.
Okay. You and I have spent a lot of time, Jeff, over these recent years talking about mergers and acquisitions. Certainly it was at a high point a couple of years back, and it's slowly started to slow down, and even this year, it's really slowed down, right? So we have a few weeks left in 2023. What is the current state of car wash M&A as 2023 here comes to a close?
So we'll talk about maybe how the year played out a little bit, and then we'll talk how it's going to finish. Okay. The year was I'll call it a year of pause. There is as credit doubled, so these, literally they went from cost of capital maybe in the 6% range to 12. And so as the cost really that interest rate, as that was growing, it really slowed and caused these chains some reason to pause. They had to get recapitalized, a lot of the buyers. Credit was really tight, if not impossible. They had to look at their own, and they had to look at take a hard look at what they bought too, right? A lot of guys grew very quickly, and it was sort of that get big fast kind of era we were living in, to all of a sudden absorbing what they already bought. And so, it was, I would consider it a year of pause. I would guess the volume was down 75, 80% from a year ago, which is significant. Now, what does it look like as we finish up the year? We're in the middle of, we've got about a handful of deals yet to close between now and the end of the year. So it feels like at least the market is starting to figure out what they want to do going forward. And so we'll start seeing deals, I think, finish off at the end of the year. And I think, importantly, going into 2024, I think we'll see more deal activity.
That's great. Yeah, even though M&A slowed, the car wash market is still healthy, and there's still interested buyers and sellers out there, no doubt, right? So
for sure. That hasn't gone away.
Now, one thing we do at PC&D annually, Jeff, is keep track of these big car wash chains, specifically conveyor car wash chains in the industry, and we call it our top 50 list of U.S. conveyor car wash chains, right? I know you've had a chance to look at our list this year for 2023. Were there any surprises on our list this year that caught your attention, and if so, why?
The things that, when you really look at it and analyze it, what you're seeing is most of the private equity-backed platforms kind of slowed down, if not came to a halt, right? Very little growth in that side of it. What's interesting is watching some of the singular, I would say, founder-driven platforms continue to grow aggressively. So when you look at whether it was Club, Car Wash, Tidal Wave, you look at Superstar, Champion is a new one, sort of that's really been on a growth here. Quick Quack, so those singular founder-driven, operated platforms seem to be growing aggressively, where private equity pulled back. So I'd say that was one of the bigger things we're seeing. And then the new entry really with Tush Card when they came in and bought True Blue. So now you got Gas C-Store entering in that space. So I'd say really the surprises were, just how much pause we've seen from the big platforms, almost universally, but the continued growth on those, single brand operated chains.
So why do you think the non-private equity companies are able to sustain this growth? Is it because they already have the knowledge of what it takes to be an excellent operator, while private equity is a little bit more focused on the balance sheet and trying to make sure they're going in the right direction? Is that what's going on?
There is certainly, I would say, some, they definitely had an advantage because most of them had operating platforms, and they knew how to run a car wash. So for them it was, and they were disciplined. So as they're growing their chains, they're doing it, with their own money. Now a lot of them have financial backers behind them, but with that founder-led team, they've got really teams in place. They understand what they're doing in operating. So scaling for them was way easier than some of the platforms that just got in the space. And again, they didn't know what they didn't know. They had to build their culture. They had to build their team. And so I do think there was some advantage to some of those other chains.
Okay. Another thing you and I have talked quite a bit about in recent years, as all this M&A activity is kind of heated up, is when is a larger chain going to buy some of these we'll call them mid chains on the top 50 list, right? So we saw this with Mister's acquisition of Clean Streak, right, not too long ago. But why haven't more 20 plus chains sold to more 150, let's say, plus chains?
So I think there's a few factors. And number one, most of those larger chains that wanted to sell sold. Right? So they were smart enough to see the tea leaves and say, this is a pretty good time to sell. I'm going to let's go. That was sort of one factor, but the biggest factor of all is just the cost of capital. And so as a cost of capital, and it was, again, most of the major platforms were capital constrained, right? So it wasn't a matter of even agreeing on a number. They had to spend a great part of the year just getting their balance sheets in order so they can go out and buy anything, let alone a chain of 20 or more. So I think with the cost of capital and the constraint of capital, it really prevented from those deals getting done. And then I think lastly, you've got you had a lot of people sitting there and waiting to see whether it was the buyer or the seller saying, okay, where's this market going to go? On the seller side, you got to say, okay, is the market going to come back and start giving us those multiples that we were getting a year ago? And the sellers were saying, how low is it? And the buyers were saying, how low is this going to go? Right. And they also needed to better understand where I think the consumer was going as well. So I just think it was part of the overall pause factor, and just the realization on really where valuation's going to stabilize at.
So we're not taking those big deals off the table, just not anytime soon, of those 20 plus chains selling to larger chains.
I think not. I think for now, I think it's still going to be, will anything get done in that size range? Maybe, but I still think it's going to be, those kind of groups that at least, and we're talking to a lot of them now. I think they're going to continue to grow their platform. They're going to keep maximizing their value, because a year or two ago, people were the buyers were leaning in and buying on pro forma. So when you look at the 20 or more, typically they got mature sites, right? Then they've got some sites that were recently opened, kind of their babies, and then they have a development pipeline. Well, it wasn't long ago they were getting credit for that development pipeline in some of the newer stores. There's no more leaning in. So now you're going to find that most of these chains that are 20 or more are looking at it and saying, if I want to get maximum value, I've got to get these sites to maturity before I go out and sell them, because today things are being bought strictly on what your current EBITDA is, with very little leaning in.
Okay. All right. I want to take you back to 2021. Jeff, mm-hmm. It was interesting at the recent NRCC show in October. It seemed, especially at the social gatherings, I had a lot of conversations with people talking about Mr. Car Wash's stock price, and that was a topic I've never talked to anybody about in this industry, because Mr. was really the first independent operator to go public in June 2021, right? So, knowing what we know now, was that the right move at the right time for Mr. Car Wash? I know you and I at that time talked about that maybe we anticipated other independent car wash chains going public as well. That didn't happen. So why, I guess a two-part question as a follow-up, why haven't other car wash chains followed suit?
So at the time Mr. went public, the public markets were smoking hot, right? So there were a lot of companies going public at that time. That was sort of one, right? Then you had, it was the investors' turn to get access to permanent liquidity, mm-hmm. and to continue to grow the platform out. So they, at the time they had really good reasons why they did it, and it made sense. If you look at the market today, a couple years later here, very few companies are going public. Forget about just Mr. It's just very few companies are going public. You've got a lot of uncertainties in the public markets, and you look at, take the investor at the time. You're getting almost 0% on your money, and so a lot of money plowed into the public markets, a lot of money plowed in the private equity, and today, I'd say there's a lot more conservative approach when you could get 5% just by putting in and calling it a treasury or money market. You got a lot of money still sitting on the sidelines. So I think it was the right move at the time, and I think Mr. is a long-term going to be a long-term player. So I think for the long run, this will continue to be a good vehicle, and starting to see some of that stock rebound. Others getting in the market. There's certainly chatter of some other groups looking at it, but I don't see it happening tomorrow, right? It's probably could be a couple of years out. I think the market's got to get a little stronger, and I think some of these platforms got to really build out their story. But I wouldn't doubt there's going to be another one or two more companies going to try to go public, but it's just not going to be now.
Okay. I want to turn the attention back to M&A activity and buyers and sellers, right? You know, we saw multiples that this industry has never seen in 2020. You know, will multiples ever reach 2020 levels again? And what are some realistic multiples that sellers can expect now in 2024?
Yeah, great question, Rich. Because and there's a lot of people, you know, looking at this and saying, okay, where are we, and are we going to get back? The answer is no, right? And if you tell me money's going to be free again, then I can tell you, you know, we've got a better chance of multiples improving. But we just don't see that happening. I think rates can go down a quarter point, maybe a half a point next year, but it's not going to be significant enough to change that where these multiples go. That's just one part. The other part is, you know, when you look at the amount of washes that have been built, and I think a lot of the early reports about how many tunnels were in the market were underestimated. I think we've got a lot more tunnels out in the market, and so, you know, I think when we look at this space, you had a lot of early washes come out and build, and numbers just hit it out of the park. And I think with competition, it's real. And I think the professionalism from the buyer today is looking at this thing now with a lot more data and analytics at their disposal. They also, you know, early on when you had a lot of buyers buying car wash chains, the risk for them was losing a deal to someone else. They weren't really looking at the risk of owning and operating something as being. It was losing a deal to another PE group, right? And I think that risk that's all off the table now. Now it's all about they bought in. The buyers that are in the space are the guys that are going to be in there, and they now have. They've got to look at their own company. They've got a lot more. They understand that, you know, some of the cost from regional managers to maintenance and CapEx is real, and so they're starting now to really layer in all of this into their analysis and buying these chains. And I really do believe that, you know, where we're settling in now is probably a pretty good place where we're going to continue to see stabilization in multiples, but I don't see it going back anywhere near where we were before.
Okay. Yeah, and we certainly discussed some of these factors already in this interview here, but what were some of the contributing factors? Was it all attributed to rising interest rates here? What were some of the contributing factors to M&A activity slowing down in these recent years here? And will any of these headwinds kind of wane as we go into 2024?
Yeah, I mean, so, you know, certainly the biggest were interest rates. The impact of interest rates and how aggressive it was took a lot of people by surprise. And then the credit markets, the capital constraints were big, where a lot of the platforms had to go out and really redo their balance sheets just to have cash to be able to continue to go forward in any way. The other thing is the pause was looking at, you know, the consumer and saying, where's the consumer in all this? Are we going to hit a recession? And you know, that was sort of a big reason to pause, to say, okay, we just don't know where this, are we going to be a soft landing? We've heard a lot about it. You know, and then we had, you know, platforms taking a real deep dive into what they bought, right? And they had to look at it and say, okay, let's look at now, how are these performing? You know, and I think those are the main reasons, I think, you know, that contributed to sort of this pause. But the good news going forward now, you know, if we're looking at some silver lining here, is that the majority of the major platforms out there that got in the space have gotten fresh capital, and there's at least their balance sheet now sitting there where they can do deals going forward. Two, I think they've got smarter, right? And when I say smarter, they've got a lot of now data and information to review, so they know what to buy and how to buy something going forward. And then on the consumer side, the good news is they're proving to be quite resilient. You know, we're looking at now, we've got inflation sort of under control. You know, we're getting a pause on raising interest rates, if not maybe even talks and chatter about maybe lowering it sometime in 2024. So there are some positive signs ahead, but with that, I still think it's going to be, on a go-forward basis, very disciplined, very conservative buying. And that's where I think operators today really need, you know, all the help they can. If they're thinking of having an exit sometime in the next year or two, they got to really understand what are the buyers looking for, because the fact of the matter is the power shifted, right? The power was, the seller had all the power, right, because you had a line of buyers looking to buy, and today that power shifted to the buyer having all the power, and you either got to decide you're going to stay and pause, or you're going to understand, you know, what are the buyers looking for, and how could you make sure your chain's going to get max value.
Okay. So as we head into this new year, Jeff, I know a lot of operators probably look to your company for some advisory direction and guidance. So are you expecting any significant changes or shifts in the car wash market this upcoming year, 2024? And how are you best advising your clients to you know, stay on top of these trends and shifts to best have the best performing
Right.
site?
So I think the good news is the deep freeze and pause. I think now there's a pathway to go forward again, because of, I think the capital markets have loosened up a little bit. It's still expensive, so we still got to know what works today from a seller standpoint. But the good news is there is capital that can be deployed and actually do a deal. You know, I think when you look at the on the 2024, you know, look forward going forward from a operator standpoint, what they should be looking at is the way to get more value out of your chain is going to be operating at the highest level, right? And you know, so you know, I think the one thing that you won't see happening is you won't see any takers for C and B minus kind of stuff, right? You know, these buyers now are going to be highly selective. They're going to be looking at chains with good unit economics. They're going to look for chains that are in markets that have good growth, ability to grow. They're going to be filling in their own footprint. So I think there's, you know, from an operator standpoint, they really got to make sure, man, they can't make mistakes on going into just any location and a buyer will buy it. They've got to be going in an A+ locations and really getting unit economics that are going to be something that's going to attract the buyer.
Yeah, unfortunately for the car wash industry and these operators, real estate developers are looking for car washes, you know, to be front and center in these A+ sites in front of shopping centers and
Sure.
high traffic areas, because the traffic that they can bring and just the aesthetically pleasing aspect of what a modern car wash is today, right? So that's great news. Well, had one more question for you, Jeff, and I certainly appreciate you coming in and taking some time with us today, but I know your company is more than just an M&A advisory firm, right? And in recent years, you've brought on subject matter experts and obviously operators who have been in the industry to help your clients. So as we look at these next couple of months, and I know you're staying on top of the trends in the industry, Jeff, are there any services or new services that your company is either offering today or expected to offer to help customers out?
So sticking with, you know, why we got in the space in the first place really is to help maximize the value of our clients, right, of their business. And at the time, you know, we saw no better way than, you know, taking advantage of a really hot M&A market, right? But if you look at it this year, you know, markets are, you know, down 80%, but we expanded our team, right? You know, call me crazy, but what we looked at it and we started planning this 18 months ago when we looked at the market of being super hot, and we looked at it and says, okay, what are the challenges going to be coming up here? And one is we looked at, we really needed to focus on operation excellence, and we knew integration was going to be a challenge for especially the big platforms that were buying multiple chains, and we saw advancements in technology. So as a firm, we committed to really adding really deep expertise in multiple areas. So we brought in experienced Wall Street level talent, and we're opening an office on the East Coast.
Oh wow!
And it really is to provide. We needed to be closer to Wall Street. We needed to be closer to capital markets, and so it helps. It always helps us to better understand what our clients are going through, what our buyers, sellers going through. We needed to have the absolute best people, smartest people we can find to getting us that inside look at saying, okay, where are the markets, and so we can better direct our clients, right? So we've got our capital markets team, and then we brought in our operations excellence team, and we've hired, again, the people we brought on are guys that really helped build and scaled car wash platforms before. We're bringing, the team is expanding with more operating talent nationwide, and we're finding a lot of demand really from chains that are looking for guidance and everything from driving more memberships to keeping more memberships to cost. So as we go forward, as we look at going forward, the opportunities really are to help are going to be, how do we maximize the value of our own on an individual site? And it really is from the initial cost to building to it could be technology and how we operate these sites. And so we made investments into AMP memberships. We invested in the Retention Express, and we'll continue to look at trying to become a conduit to some of these great technologies and innovators that can help improve the results for a site on a site level. So that's going to be a big part of where our growth strategy is going to be going forward. So I would say we're really about making sure we have a nationwide footprint. We really consider ourselves a full service advisory firm, and really we're not looking at what's important to Jeff. We're really looking, saying, Rich, tell us let's figure out where you need help today and help come up with a strategy, because, and again, we've always been long term. We're going to be in this for a long time. We're not looking to go away anytime soon, and we really want to maximize the value of our relationships. So the only way we can do that is having absolutely the best talent on our team at every level, so we can make sure we're addressing what needs and opportunities that you have in front of you. The other on the larger scale, the platforms are have their own set of challenges, and again, we're just trying to be good stewards to the industry, helping share wherever we can to make this industry long term and better for everybody. So you'll continue to see us evolve and grow the team to really bring on the smartest people we can at every level.
Not slowing down anytime soon.
I'd say doesn't look like we're going to be slowing down anytime soon.
You got a lot of exciting things.
Yeah, a lot of it. And again, I really think that my experience in high growth industries helped me prepare for this, because I know what went up goes down, and I also realize that this is a really great business. It's a great industry. We're still seeing really strong stickiness of memberships. The consumers adopted and really, they value memberships. You got a high margin of business, right? So you still got really great things to like about this business here. And I think at the end of the day, we got to look at this thing as it's a marathon, not a sprint. And so, for people that were able to take some chips off the table when the time it was good, great. I think for others, I still think they're getting great results, but they're going to look at this thing as this is a long-term marathon type business, and the guys that stick with it are going to come out way ahead. So we're fully committed to sticking around for a long time to help see this industry grow and excel.
That's great. Yeah, I know. I've gotten to know a few people over at Amplify, and you certainly lead the charge, but the passion is undeniable from you and the folks over at Amplify. How much you care about this industry and your clients certainly comes through. Understandably, you get a lot out of this industry. You also give a lot back. I know you don't really like to talk about it all too much, but Amplify was recently one of our Champions of Charity honorees earlier this year. So I know you do a lot of charity work with the people in the industry, and we certainly appreciate that. You've been talking with me for years, Jeff. You're never shy to take an interview with me, and I definitely appreciate that. And thanks for stopping by our office here in Akron, Ohio. It was
Well,
great
we appreciate it, and I'll just take a shout out to the team. I mean, I think if somebody said what is the key difference of Amplify, today from a year or two ago, it's amazing how much talent we have on the team that are adding really unbelievable input to the leaders in this space, and it's not coming from me, and I think I'm doing my part, but I'm just one part of a team that just does an amazing job. But it's kind of exciting to watch the evolution of the team and just how much input they're having on this industry. So if anything we've done right, I think it's definitely that part, and we're looking forward to. I think we're looking forward for a new year. 2023, by all counts, has been challenging for everybody in this space. There's no question about it. And I think looking forward to 2024, I think you'll see stabilization.
That's great.
And I think you'll see some growth, but it's going to be much more disciplined on every level, which I think is going to be welcomed by everybody.
All right. Well, hopefully we can catch up in 2024 and discuss some of these trends again, Jeff. It was great seeing you today.
Pleasure's
Thanks for
all
doing
mine.
this.
Thank you.
This has been Professional Car Washing and Detailing's Executive Spotlight with Jeff Pavone, founding partner at Amplify Car Wash Advisors and owner of Commercial Plus.